This one concept is being missed greatly by most traders. We're trying to determine what type of market we're in. Is the stock market in an uptrend? Are we in a downtrend? Is the S&P 500 getting ready to break out, or is it going to take out a new low? You can see here already that we have been basing since about June. The significance cannot be overlooked because right now we are fighting for our lives with the financial sector. We are trying to see if we're going to hang in there, how bad this financial crisis is going to be. We are trying to determine when is it going to end, which banks are going to make it, which ones are not. But what if we're asking the wrong question? What if the questions are, why is the technology sector continuing to go up since January 2023? Why are we testing a resistance level and forming wedge line? Why is Apple and Microsoft keep climbing if we're going through the great financial crisis? Well, we're going to go through this and a couple other things, point out some really glaring inconsistencies, and try to figure out exactly what's going on here and how to profit from it. Regional bank space and the absolute destruction of it over a period of time. What names actually look attractive, which names don't look attractive, and how this usually ends. This one concept is being missed greatly by most traders. We're trying to determine what type of market we're in. Is the stock market in an uptrend? Are we in a downtrend? Is the S&P 500 getting ready to break out, or is it going to take out a new low? You can see here already that we have been basing since about June. The significance cannot be overlooked because right now we are fighting for our lives with the financial sector. We are trying to see if we're going to hang in there, how bad this financial crisis is going to be. We are trying to determine when is it going to end, which banks are going to make it, which ones are not. But what if we're asking the wrong question? What if the questions are, why is the technology sector continuing to go up since January 2023? Why are we testing a resistance level and forming wedge line? Why is Apple and Microsoft keep climbing if we're going through the great financial crisis? Well, we're going to go through this and a couple other things, point out some really glaring inconsistencies, and try to figure out exactly what's going on here and how to profit from it. Regional bank space and the absolute destruction of it over a period of time. What names actually look attractive, which names don't look attractive, and how this usually ends. Hello traders, we've got a lot of ground to cover. To start with, we got through quad witching pretty much unscathed unless you were a financial. These are the four kinds of contracts that expire on quad witching. Now, I think it's important to just point out the obvious before we continue. We can see this line going straight across from November and how this area up here, right around that 4,100, has consistently been an area of support or resistance, and we are constantly rejecting in there. So we know where the top of the market is, and what we're trying to figure out now is where is the bottom? Well, it's quite possible that we're going to hold this 3,800 barring some new catastrophe. Now, could there be a new catastrophe? Of course, there always can. You have a DTL right here, downward trend line. That's pretty glaring what's going on and that you're unable to get above that. But at the same time, you have these smaller ones that have developed because of the amount of froth that we had in certain sectors, and also the amount of loose regulations in the regional banking space, which is becoming abundantly clear with these losses, and what the Fed did with the 10-year spiking it up so much with unprecedented rate hikes. So now the question is, what do we do? Well, if we look at what's been happening, we've been respecting levels like this for some time. In other words, we're respecting our trend line. So we have to understand that if we're respecting them, then when we break them, it has significance. And here we clearly broke one. We rolled. That 4,100 is a place of consequence. So the very first thing we have to understand is that our resistance, at least in the short term, is going to be 4,100 barring anything. So what would get us over that? Fixing the financial crisis that we're dealing with right now, that would be one thing. Earnings coming in that are substantially higher than expected would be another, but there are signs already showing what's going on. For now, what we're going to focus on is just looking at the S&P and understanding that 40, 20, and in this area to get up to that DTL is going to be pretty substantial. But also, if you just kind of come across, look at that gap fill, that puts you right at 4,000. So 4,000 up there is probably going to be an area as well that we have to watch. Now, if we look at the S&P weekly and we just take a moment and say, okay, this could be the head, this could be the left shoulder, this could be the right shoulder. And we just play devil's advocate and look at it that way and understand that necklines don't have to be straight, it can be crooked. So you're looking at this and going, is that a possibility? It is. If you look at the SPY weekly, how come we have so much buying going on if we're going to collapse? That doesn't make a lot of sense. Now, this is corporate bond yield spreads, and we're looking between 10 years right now. And I'm going to explain why us waiting for this crash that's supposed to happen, the stock market crash is supposed to happen, it's not making a lot of sense. And I'm not saying that it doesn't happen, because of course anything can happen, and we always have to understand that, right? Anything can always happen. And as a trader, I'm always the first to say you protect your capital and then you look forward. But let's look at these 10 years and suggest that these spreads, the wider the spread, the more trouble that companies are in. Tech companies, financial companies. Now, if we just take a look at the spreads here and go, okay, well, this was 2015. We all remember that. We all remember the pandemic. And then you look at where we're at right now here, and then you drill into that number. Now, as we drill into this number, we start to realize something, that these little areas right here just took place when the S&P was pretty much bottoming, right? So you can see the bottom here, these little spikes. Now, I'm not suggesting that we're at a bottom, although I think that there's some argument to be made there. But what I'm suggesting is we're not even above on the spreads, meaning that what you're looking at here is AAA versus triple B rather. And why that's important is this is, think of this as junk. Think about this as the top bond that you could possibly own. The wider the spread, the more the borrow is for companies that really can't borrow money, right? It's harder to borrow money. Think if you have a great credit score versus like a really bad credit score. So now you look at what's going on here, and you can see this top, and now you're looking at it and going, well, wait a minute, we're not even in the June level, which did mark a bottom in the S&P. We're not even at that October level, which, quote, marked a low in the S&P. So can this get up and can this get worse? And the answer is absolutely yes. But for now, it's not. For now, we're nowhere near these levels. So why aren't we seeing that panic? You do me a favor when you get a chance and just comment on the white background. Some people are telling me they're having a hard time with it. I can go to a light gray if we think that's better. I may have to change the color candles, but just let me know. I appreciate your comments. I find them greatly helpful in creating content. So let's just talk about the high yield and what's going on in the high yield market. Now, why is the high yield market important? Well, the high yield market's important because this is the cost for people to borrow. In other words, are the costs going up? Are the costs not going up? I think that's pretty significant. Now, if you're looking at these levels, we're holding support again. So now here we are once again waiting for this, quote, crash, and here we are. And I'm not saying that it can't happen. What I'm saying is that we are not seeing signs of a stock market crash at all, despite what's going on in the market. Now, you may look at banking stocks and say, well, it certainly feels like a crash. Now, we've all seen the charts that are out there, but we're going to walk through it here. This is the US 2-year, and it feels like a crash. Well, this is one of the greatest moves we've had since 1987 in the bond market, and the 2-year and the fluctuation of it. The just significant move is just unprecedented. And you're basically looking at 100 basis points in a week on the 2-year Treasury. So now we have the 2-year Treasury dropping. There are some things I like about this. There are some things that I don't like about this from a bullish perspective. We're going to address both. First and foremost, this is the level that we peaked at in 2007, which led to the great financial crisis. You have the same exact peak going on right now. That should not make you feel warm and fuzzy. You should not be looking at that and going, oh, okay, I don't want to be a party to this if this is going to continue down, right? You're not going to want to be overly bullish. Now, I'm going to show you another graph in a couple minutes here as to why that's significant. And I'm going to include 5 graphs in a email or form below. It'll be linked in description. So I'm going to go through a lot of graphs today. The top 5 will be in that, so you can look at the top 5 going forward on the week. I think it's a good way of doing a recap on what we're about to go over, because this is going to be a lot, what we covered today. It's going to be in depth, and you're going to have a much better perspective on what you should be doing as the week progresses and what you should be looking for. So your comments are the reason why these videos are longer and more in depth. You asked for it, so we're going to do it. Now we can see the level right here, 94, 93. That's not a bad thing, is it? So let me explain to you what I mean by this. I keep hearing that the pivot's bad, the pivot's bad. I never made more money than I did in a pivot than during 95. The Fed pivoted, and I was literally just starting. And when the Fed pivoted and Greenspan pivoted, we had rates spike. That spike taught me very quickly, one, the quote, "Don't fight the Fed," makes a lot of sense. Okay, so that's definitely something we have to pay attention to. But it told me to start looking at the 2-year as a reflection on what's going on in the market. Not so much on where it is. Obviously, people loved zero because they could go out there and create the metaverse where we could be a giraffe or start 47 different kind of EV companies. Innovation can happen when you have lower rates, but it's not realistic to pay zero for the rest of your life. So here we are. We can see this rally up, comes back down, retests that area. Well, that's interesting. So we held there in 94, and then we have this other area right here. Well, what's that? Well, for those that don't know, this is when Russia defaulted on their bonds. When they defaulted on their bonds, the technology market imploded. It was a huge buying opportunity, quite frankly. And once again, understanding this and not fighting the Fed when they created an emergency action, we were able to profit from that. And then, of course, you have the massive sell-off. This is the point that I want you to take. This might be a line that I've noticed in the past mid-90s, late 90s, that presented an opportunity for me to get involved in the market. Does not mean it's going to present the same opportunity here. And what you are looking at is a monthly chart. Does not mean it's going to happen on a Tuesday. And I want to be real clear about that. So what we're going to have to do is focus on these levels and see if there's something significant. Is there anything else more that we could learn from this? Well, so far we know that this is a historical level that's been going on since the 90s, let's call it. We know that we've bounced in here. And we know that we're sitting there again. We also know that this is peak, and we also know that we came down at the same level from 2008. 2006, we'll say, was the peak because that was June 2006 and came down. And then we're here now. So we have this peak, and that doesn't make us feel warm and fuzzy, but we have the support, and we have the single greatest move since 1987. Now, in front of us is S&P valuations on a PEG ratio. Price earnings growth ratio for those that aren't aware. Think of it as the PE divided by annual earnings growth. So now we would look at this in front of us, and what we're looking again is historically and going, okay, well, what area are we in? So what we could do is just take this level and go, okay, well, seems like a pretty historic level when we're above that 1.5. Seems pretty historical, so we can look at that level and see right there how we're doing. And now we're above that level. Well, if the price earnings growth ratio is high, well, people would look at that and say that can't be great, right? Because you don't want to pay more, you want to pay less. I mean, that's definitely what everybody wants to do. And then you look at it and go, well, is that really what you want to do? Because if you bought on the way up, sure, you did great. But if you bought on the way down, did you do well? No, because earnings are collapsing. This is telling you that earnings are not collapsing right now, that we are suggesting that earnings are going to collapse, but they're not. And we're seeing that. So could earnings still collapse? Yes. Could we get a major scare like we did during the pandemic and get a spike up to here? Absolutely, that could happen. But historically, if you look at this level that we drew, we have this level right here in 09 or 10, which basically marks the bottom. And then you have another level right here above us, which marks the 2015-16. Now, if we zoom out on the chart and we just take a look at what this is telling us, it's pretty clear. Here's the 2009 level and that peak when you had that high spike. Here's 15 and 16 when you had that high spike on the PEG. Here you are again, where you're having that spike. And here you are once again, having that spike. Does not mean it's going to play out the same way. I want to be really clear about this. These are weekly charts. This is not something, again, that's going to move on next Wednesday or Thursday based upon what I'm showing, but it does show where you're at historically over the past, let's call it 15 years, and pointing out 4 examples where this did call a bottom. So now we have the financial market completely imploding, but at the same time, we're looking at the PEG level and we're looking at the 2-year, and we're trying to connect all the dots. So now we go and look at the NASDAQ. And as we're looking at the NASDAQ, we're going to use the weekly volume. And this is a real easy way to look at the weekly volume. This is just a way that I look at how the world goes in regards to volume. A couple different clouds I have in here. And there is a line that I use right here as my demarcation line. Someone else actually created this, and then I just kind of tweaked it to the way that I trade. But what I'm looking at here, going straight across, this is buy volume. It is green. It is lit up like a Christmas tree because it is out of every single cloud and indicator I have on above average volume. You can see that there's only so many green bars here. Now, I want to point out what I think is very obvious. Here is a very large green bar. Here is marking the bottom of the market in the NASDAQ. Here is a very large green bar. We rallied and then rolled. Does not always point out the fact that you are going to bottom. But you need to pay attention to this, and you have to understand where you are, right? So in other words, just because it's one data point of information doesn't mean that, oh, it's a clear sign, right? What we do is we look at this and we analyze. And by analyzing, you start actually getting better at analyzing. The more you do something, the better you get at it, right? So instead of me being someone that's going to say, oh, the stock market crash is coming, or we're definitely going to rally, the bottom line is there are so many factors out there right now on whether or not we rally or whether or not we crater. How the Fed handles next week. Are they going to raise rates? Are they not going to raise rates? How much are they going to raise rates? By the way, the recent report, I'm not going to spend a lot of time on it because I know a lot of others do, but they're looking at 25 basis points. That's where we're leaning right now. If the financial crisis doesn't get better, I don't think they're going to do anything, but I don't think they're going to do anything more than 25 basis points. If they do, the market will absolutely implode. Now, if you look at what's going on here, and if you don't agree with that, comment, but I'd be real interested in hearing your thoughts on that. I've been wrong, and I've been wrong before, and I'll be wrong again. But you see this level in here and how you're bouncing? Well, we're holding the 200-week moving average and we're going sideways. Well, this is the exact kind of basing that we've just been talking about happening. So while we're not in this position where we just started to collapse and we're getting a move like this, we're also not at this absolute trough level like we were back here. So we know where we're at in the grand scheme of things, right? We know that this is very different than both these times. So all we can do is look at this and say we are basing, and the fact that we're basing in here for a period of time since May, we're going to use the top of this from May and we're going to use this low in October, we've been basing. Anything can absolutely happen. But for now, this is what is happening. So we are basing, and we have some of the highest volume that we've had in over a year, and then since then 2 years. We can't rule that out. Now, in front of you is the VanEck Semiconductor ETF, and I'm just going to point this out here and then on the other one as well. Here you are with the socks, left shoulder, head, right shoulder, neckline. You could actually drop that neckline down a little bit more, but here you are. Well, what's the close of that number? So the close of that number is 250.32. What's the close right here? I always look at the closes. I want to know where we closed. Why? Because institutions buy at the end of the day. I've gone over this ad nauseum in several different videos, and I will be covering it a little bit today just so you can see where we're at. So if we look at this again and go close, okay, 245. So let me get this straight. I have not closed higher on the SMH VanEck Semiconductor in 52 weeks. It's been a year. So in other words, the semiconductor weekly close is at a 52-week high. You don't see that when the market is going to crater. Now, you always see these perma bears, and they always talk about, here's our ship, and this is the low end of the ship, and we're going to sink. Right? And that's what's happening right now. We're at the top where we're saying everything's fine, but then these people are going to get hit too. That kind of group think is going to get you in so much trouble as a trader. It's not even funny. You have to trade what's going on. That's all you can do. And as it changes, analyze your process and retweak your process and get better. That's all you can do. Do you want to sit here and watch this market rip or go higher and not participate in it? Do you want to watch it roll and say the market's wrong? You don't want to be that person. You want to be the person that's always in control. You have a flag here, a bull flag and a 52-week high on the semiconductor index, the VanEck SMH. That's a fact. That's where you're at right now. The semiconductor index in and of itself, this is what more people look at. And you can see right in here, you're going to notice that you actually have a higher high close in here. You have the same pattern right here, and you're right on that neckline with a flag. And here we are. Now, how many people are out of position going into the Fed meeting right now? In front of us is the smart money, dumb money confidence indicator. As we're aware, we don't use the indicator here like that. For those that are new, we don't refer to this as, quote, smart money, and we certainly don't refer to this as dumb money. We refer to this as institutional money, and we refer to this as retail money. The indicators that make up this list confirm that this is retail and this is institutions. For some reason, they like to refer to retail as dumb. I would make the argument that retail absolutely crushed institutions. As institutions sold at the low right here, and you can see very clearly, retail was buying. So retail made all the money on the move. Institutions sold as it went higher. But the disparity on what's going on now and the inflection is what's interesting, because now we have an actual financial crisis that's going on where we are losing banks. And as we're losing banks, institutions are buying very aggressively into that. Now, we're at a level here where they're getting pretty optimistic. And if you look at that smart money, when they get optimistic, you have to ask yourself, does that matter? Is that something that we have to concern ourselves with? For point of reference, this line that's dotted, that line is going to be super optimistic, and this line is going to be super pessimistic. You can see how retail feels about things right now. You can see how institutions feel about things right now. What we want to do is say, well, when they get too optimistic, when institutions get too optimistic, is that good or bad? So let's just take 12 months. So we're going to look at this from a 12-month perspective, and we're going to look at the peaks and valleys on who was right and who was wrong. Well, this is when we were at an ultimate level for smart money or institutions. And you go, okay, well, that's okay. And then you moved as time went along and you did okay. All right, so I kind of get that. And this is when we didn't really have a lot for retail. And then they kind of decided to peak out right here. And retail got really heavily invested in August, September. And we can see that really glaringly right on where we're at there. And that's definitely something we want to pay attention to. And we want to look at when was institutions getting the longest up here on the bottom. So even though they're the most optimistic here, they're buying up there, right? And who has the least amount of stock at the bottom? Retail in this example. Now, this graph, obviously in flip, you had this movement of sideways action, which you didn't have any over optimistic or over pessimistic situations, right? We didn't have anything in between here. But October was the time that we have retail really shining, not on the way down so much. They were actually selling on the way down as institutions were buying some, but we didn't really have that pessimistic level on institutions. So there probably wasn't really a lot for them to do. But now you have this area that is very significantly different. And I think we should really talk about this for a second. In 3 years, you have not had smart money under in 3 years. So you have to go back to the pandemic to find any time in 3 years where we were this low on institutional ownership. Now, what does that mean? Well, you have retail selling and you have the lowest peak right now on institutional buying. Why would it be here? And why would retail be dumping so fast? Now, let's play devil's advocate. Yes, they are buying. Yes, they are being aggressive, but they weren't as under as they were during the pandemic and then as stocks traded up. But why the panic now? Why are they getting so aggressive now? I use this chart to explain a lot on what's going on out there right now. And if you've been following for some time, you're going to want to pay attention to what just happened on Friday. So here we are, and this is the last hour. And what this does, it's a very simple algorithmic equation to determine who is buying in the last hour, who is not buying in the last hour. And one of the key things that I have said is you want to look for peak and trough levels, but on a relative basis. Well, we could all know where that is in December. We all know what happened to the market from December on. And we can see the last hour how institutions buy. Now, the most important thing about this, they're not stopping. They're buying every hour. Market goes down, they buy. Market goes up, they buy. They are constantly committing capital to the point where we're talking about which financial bank's going to go under, which regional bank's going to go under. And the last hour's at highs that we haven't seen for over 2 years. So not only when you look at the smart money, dumb money, are they putting money to work, but they're putting money to work at a faster clip through more names, or else this wouldn't be hitting highs the way that it is. So if we know this, and then we look at things like the semiconductor index, if we look at the technology space on a weekly basis, and we could say, kind of wonky, but you have a left shoulder head, right shoulder. I'm on a stretch there, guys, with that one because it's already broken. So I'm not really real comfortable pointing it out, but the pattern of a W is there. But it's really hard to call that a head and shoulders. Now, what do we have here? I have a flag right on a key level. And now I have this wedge. Now I have a bullish engulfing on the weekly on technology ahead of a Fed meeting into a regional banking crisis. You think people are in position or out of position for what they think is coming next week? To me, it looks pretty clear that they think they're out of position and that you may get some kind of relief rally just because the uncertainty's over. I will say this about next week, and I don't want to spend a lot of time pontificating on this. I'm in the 25 basis points to them doing nothing camp. I think what happens this weekend is going to be significant and matter in regards to what they do with the banking system, how many banks merge, private placements, things like that. I think it's still up in the air, quite frankly, but I think it's between 25 basis points and doing nothing. If they do 50 basis points, all bets are off, and I would think that the market's going to come in. Now, most people are looking at copper futures, and they use copper futures to determine the health of the market and the health of the global economy, meaning if you're out there and you're buying copper, things are good. And if you're not buying copper, things are bad for the economy, and the economy is getting overheated. You have a lot of people on both sides of this trade buying copper and selling copper. I'm just going to point out the absolute obvious here is that you just very simply hit a resistance point and you reject it. I don't know what happens with copper. I have my opinion on what's going to happen with copper. I look at it as a guide, and that's all I would look at it with. I would not get crazy about the fact that you're getting to a resistance point, a multi-year resistance point, and you reject it for the first time. It's not the end of the world to me. Usually first rejections happen. Now, let's get into the regional bank space and what the heck happened. So FRC, they came out with what appeared to be great news, but when people started to drill into it, it wasn't as great as they thought. Essentially, all they were doing is taking deposits and rotating deposits, these large banks, in and out of FRC in order to fix the problem. Well, that's like putting your finger in a dam and then another hole's going to leak. What they need is a capital infusion. And that's the way that they worded this, that they were going to leave the money in there, not rotate it in and out. Now, as I start going through this, that is somewhat concerning that was their game plan. Because really all that was a smoke and mirror for the public. That's a problem, and it's a problem that even Yellen agreed to it. And the issue with that is you're going to lose faith in people. People are going to lose faith. And if you lose faith in the banking system, you have a real problem on your hands because now you're not trusting the bank. That's the last place you want to be, especially in this environment. So I think that this was an absolute awful move by FRC. Now, I'm saying that as somebody that is long preferred, that has a very small position in common here. I'm not so sure that this one's going to go under. Now, as I stated previously, below there will be several charts, at least 5 to 10 charts on what I think are the most significant points of what I've covered today. And I think it's a great way to recap on what I'm seeing, and then for you to have just a quick file to go and review. What's in front of us? Well, this is unrealized losses in deposits above 250,000. This is unrealized percent losses of CET Capital One, unrealized losses. Deposits greater than 250,000. This is an excellent chart, and this is something that I did not do. It was actually put out by Michael Berry. It's absolutely excellent because it explains the issues. So you can actually look at this and determine the amount of risk that you want to have. So for me, the reason that FRC is under attack where it is, and I really want to walk through this, you lost SIVB, you lost SBNY. Why? Well, you lost them because percentage of deposits were over 80%. Over 80% percentage of deposits that were greater than 250 were over 80%. So you had runs on the bank. FRC is in that position. And the problem with FRC being in that position is pretty obvious, right? That they could run into the same problem based upon that. Okay, so I want to be real clear about here when I say I own the preferreds and I have a piece in the comment. I don't think that we're going to be able to withstand losing a third bank. I think no matter how you feel about the current way they're handling this, which I think is awful, I think they understand that if you lose FRC, it's the equivalent to me of losing AIG. Not of the same magnitude, but the way that people are going to feel about this, like how many banks are we going to lose? And how many are you going to backstop? Because let's be really clear about this. You see this picture in front of you? The Fed cannot backstop all these deposits. It cannot do that. And the illusion, because it did it here and here, that it can do it for all the banks, it's not realistic. It's not realistic at all. And that's a significant problem. It's one of the reasons why you're seeing stocks like Coinbase go up and Bitcoin. So they're afraid. But what you could do with this chart, and why I think this is what Michael Berry did here is so great, is it actually shows you where on here you should be looking at your risk. So instead of me flipping through charts, I'm just going to walk you through parts of this. So these are your median lines. And this is what I think is so brilliant about it. Not only did he chart them and plot them, but knowing where the median lines are, you can say, is this above this or is this below this? What quant does it fall into, right? Because you have these 4 different sectors right here. So if I'm looking at this and saying, I like regional banks and I want to take the least amount of risk possible. Well, MTB has 10% roughly. Let's assume we're in there right around that 10, 15% of unrealized losses, and has 250,000 as the least amount, or greater than 250,000 as the least amount of their deposits. So the safest banks are this quadrant. This is your safest quadrant. And you can see RF's in here, MTB's in here. So this is your safest quadrant. These banks are actually safer than JP Morgan based upon this bank and this bank. For example, NYCB and MTB are actually safer than JP Morgan, who has a higher degree of percentage above 250. Now, I say that JP Morgan is absolutely massive and they could withstand it. If you're looking here, then this is the area that you want to play in. If you're looking at the periphery where you're trying to make the largest return based upon what's happening, you're up here. You're in the FRC, you're in the CMA, right? That's your wheelhouse. That's what you're going to be in. If you're interested in saying, well, I don't think there's going to be a run on deposits, I think they're going to stop the run on deposits because now they feel safe, you could start looking over here, right? Because now you still don't have that median loss that you have on this side of the equation. But over here, you could say, well, Ozarks, Zion, Wall, I don't think we're going to have a run on the bank. But if you do have runs on the bank and you're concerned about runs on the bank, FRC is on the frontier. Let's be very clear about that. EWBC, you're on the frontier. If you have runs on the bank, these are the 3 that you're going to have to worry about. This will be in and denoted as to who made this chart in the link in description as one of the charts that I'm going to present, because I think this is pretty significant and it gives you a quick look to determine what you're going to do. In other words, what kind of risk do I really want to take on regionals on Wednesday? Now, at the time of recording this, Credit Suisse is in talks to be acquired by UBS. If you start seeing mergers like that actually answer and fix a lot of the problems, you could see a turn on things like this. And I think that's pretty significant. I actually think that they do pull something off here and they get something done. The biggest issue they're going to have is price. UBS is going to want to pay the least. People like the Saudis, they're not going to want to be getting $1 or $2 for their stock. They would rather say we're going to hold it and see how it goes out. They own 10% of the company. I don't know how the other shareholders are going to feel about that. So there might be some delay with it. My hope is that this gets done this weekend because that will lift the sector. This is the XLF, the financials. You can see where we're at. You can see how critical this is on a monthly basis. We don't really want to close below that level. This is where you were during the great financial crisis, during the pandemic. And as I like to say, resistance becomes what? Support. And what's happening here? Support. It's doing exactly what we want it to do. So let's hope that that support holds and we'll go from there. Now for the fun stuff. What names to watch next week? If you're not watching NVIDIA, I don't know what to say anymore. We've been talking about this name forever. And it's pretty clear what's going on here, right? This is leading. And I just want to point this out. This does not happen in bear markets. Everyone's waiting for this crash. You're at 52-week highs. You're at 52-week highs on this weekly chart right now. That's not a bad spot to be. That doesn't really tell me that we're going to crater. And I really want to hammer that point home. This is not how we acted in 2009. This is not how you acted in 2000. Okay, we had rallies, but our rallies in 2000 were like this. They were vicious. They were like this. You'd come in one day short and then you're dealing with this. You come in long and then you were dealing with this. That's not what you have right now. What you have is this grind higher as people buy. And look, now you have above average volume. Don't sleep on this name and don't sleep on semiconductors right now. Now, if you're trying to participate in regionals and you want to look here and you don't want to get into the debt instruments, but you just want to look at how this is playing itself out. MTB, according to that graph, is pretty much ground zero for support. And if this one goes, I think we have a lot of problems, frankly. But if you take a look at your trend line right up here and you can see your level, look at the support level in the weekly. I don't know that we're going to break this. We are below it right now. It's not ideal. And I just think you're seeing panic and I think you're seeing massive short selling in the whole sector. You could absolutely get down to this level. That could absolutely happen. And that's something that you're going to have to think about as well. I like this name. If you don't want to be on the frontier right now, which is fine, which is where I am with FRC and some of the debt instruments of FRC, I get it. That I'm taking a lot of risk, but I want a lot of return if I'm going to do this. I've been through this about 3 times with different sectors, twice with financials, but with different sectors. I've seen this play out. So I kind of have a sense of how this is going to go. Doesn't mean it's going to go exactly the way I think it is. Quite frankly, nothing ever does. These are notes from the newsletter. There's a link in the description to get the newsletter. It is free. So here you are, Meta. And again, I do think they may ban TikTok. And what you're seeing here is you're just seeing massive buying. These are all the levels. You might want to screenshot that if you're interested in trading this name. But you really can't sleep on this, guys. I mean, come down, undercut, flip. Oh, I'll wait to buy it down here. Okay, let me know how that goes. Meanwhile, you're pushing, you're building this flag, and you're going to wind up going higher. Don't be that guy. Don't be that guy down here waiting to buy. Be the person that sets up a process on where your stop loss is, how to get in the trade, how to get out of the trade. Again, screenshot those levels. They're pretty significant. And I think that these are things that you want to watch. Now, another name that I would really be paying attention to right now is Schwab. You have insiders buying stock in the open market. You have Charles Schwab himself coming out and issue a statement saying, we're fine. And I know a lot of people are going to say, oh, well, what do you expect him to do? I expect him to protect himself in CYA and have the CEO do it. Instead, the chairman of the company and founder of the company came out and issued a statement. You don't want to ignore that with someone with that reputation doing that. It's pretty substantial. Now, we traded this in the Alpha Chasers community. Short-term trade, couple bucks, still in there, quite frankly. I don't know how long it takes to get back up here. I do know a year from now, people may be looking at Schwab and wondering why they didn't buy it. I do believe that. I do believe it's a possibility. I do think you have to look at the amount of volume that came into Schwab and then kind of go through periods of time and see if you could see anything even remotely like that, right? So in 20 years, did you even have any volume remotely like that? No. So who do you think that volume is from? You think that volume is from retail investors that are bearing this for the next decade? Or do you think that's institutions that are stepping up and starting to accumulate positions? Schwab looks very different than Goldman, doesn't it? I had a position in Goldman and I still do. I can't be looking at this feeling warm and fuzzy. Now, this is a position trade for me. So I'm looking out years. I'm not looking out weeks. Same thing with JP Morgan. I think that, yep, could you get down to 100? Absolutely. These things look like they're going to fall off a cliff. For the traders, for the swing traders, I don't know what more you want than having this doji and 20-year high volume. I mean, this is screaming to me. And could something happen? Could there be another shoe out there? Absolutely, there could. And I really want to hammer that home. We just don't know what's going to happen. Now, if you look at Tesla, again, let's clean up all these levels and just go through what exactly are we seeing out there? What is happening with Tesla? And I think there's some pretty neat developments, or I think they're neat, but I'm kind of a nerd for charts. So if you come across here and you look at these levels and you look at how we're playing out up here. Now, you can see your level here and you can see right here too, right? Look at that. Okay. Well, what do we have down here? What's that pattern? Well, that could be a piercing pattern, right? That could definitely be a piercing pattern. I don't know that we're up that 50%. Now we're going to zoom in here for a minute. I'm going to just explain this. A piercing pattern, you want to learn this pattern. They're pretty significant and great little areas to determine if you're going to roll or if you're not going to roll, if you're going to hang in there. Usually at a minimum, you go over the opening price on these kinds of patterns. You can see this 50 right here. Make that a little bigger. And you can see that you did get through that level and you did hit that 50%. So you do have a piercing pattern here, and that means that an allocation of this flipping would be great. You flip that level and then you retest that level up there. Now, I think that's pretty critical. Now, I just want to say something. I've been trading for a while, as I'll mention on these calls every once in a while, and I went through 2000, 2008. And I just want people to understand this. This is one of the hardest markets I've ever traded. It's constantly evolving, it's constantly trading, and you constantly have to adapt and you have to be on top of it. If it's not your kind of market, stay out of the way. I like this kind of market because it offers huge returns. Absolutely huge returns for when you catch it. And that's what we're witnessing right now. We're witnessing tons of imbalances from NVIDIA being down in the 90s to now 250 to Schwab, which is at 53, 54, and you're seeing these moves. And you could just look at doing very short-term trades because that seems to be what's working. Now, I actually go through it in this video right here that talks about how we picked this off at 54 3/4 down here and how we wrote it back up here for those that wanted to just very simply pull out the day trade and not have a swing trade. It's a 10-minute video. I strongly suggest that you watch it. Make sure that if you're interested in the charts that were presented, that you click the link below and get them. It's free. Everybody have a great day. Trade to win.